Costco refuses to make money on what it sells. The moat, a structural cost edge rivals can't copy, lives inside that refusal. The savings flow straight to the member. Look at what happens when you read the top line. $254.0 billion, $238.4 billion. That's roughly $250 billion of merchandise moving through a few hundred warehouses each year. And yet the margin, the cents kept on every sales dollar, barely moves, 12.6%. For a retailer of this scale, that figure is astonishingly thin. Most grocery and big box peers run gross margins 2 or 3 times higher. Costco runs leaner on purpose, and that choice is the whole story. Start with the label the company itself wears. Cost advantage, that's the category of competitive advantage we're analyzing here. A cost advantage moat means the firm can sell goods more cheaply than rivals can buy them. The question is, how a company sustains that position for decades? The first piece of the answer sits in the membership ledger. Annual fees create near-pure profit revenue that subsidizes below-market pricing, decoupling Costco's margin from merchandise gross profit. Read that mechanism carefully because it inverts how most retailers operate. The fees aren't a side business. They are the actual profit engine. The merchandise is essentially run at cost to keep the fees flowing. Membership fee revenue of $4.83 billion in FY 2024, operating at 100% flow-through margin. Near pure profit fee revenue flows almost entirely to the operating line. That's what lets Costco accept thin merchandise margins without flinching. The second piece is discipline at the shelf. An SKU, a stock-keeping unit, is just a distinct product the store carries. 4,000 active SKUs versus 30,000 plus at typical supermarkets concentrate volume per item, unlocking unmatched supplier pricing leverage. 3,700, 4,000 SKUs per warehouse versus 30,000 plus at conventional grocers. What's interesting here is the inversion of conventional retail logic. Most grocers compete on selection and breadth of choice. Costco competes on per-item volume. That volume becomes pricing leverage on every supplier negotiation. The third piece compounds the second in a way that's easy to miss. Annual merchandise sales exceeding $240 billion give Costco monopsony-adjacent pricing power, forcing suppliers to offer lowest available unit costs. FY 2024 net sales of $249.6 billion, making Costco the third largest retailer globally. At that buying scale, the entire supplier relationship inverts in Costco's favor. Suppliers need Costco more than Costco needs any single supplier. This is fixed cost leverage, the principle of spreading rising volume over flat overhead. Costco takes that principle to its retail extreme. The fourth piece captures margin that would otherwise leak to the brands on the shelf. Owned brand captures supplier margin and enforces price benchmarks, compelling national brands to match quality at lower cost to retain shelf placement. Kirkland Signature estimated $59 billion in annual sales, but at 25% of total revenue. A private label at that scale does two distinct things at once. It captures the brand margin for Costco itself, and it sits as a permanent price benchmark that national brands must beat or match. The fifth piece closes the loop and explains why the structure persists. Renewal rates above 90% signal deep member lock-in, sustaining predictable fee income that funds the low-price flywheel perpetually. US and Canada membership renewal rate of 92.9% as of FY 2024 Q4. Renewal rates that high function like switching costs, the friction that keeps customers paying year after year. The member has internalized the savings habit over many trips. The annual fee feels small against the basket the household carries home. The behavior renews itself almost without thought. Now lift the camera and look at the bottom of the income statement. 3.7%, 2.9%. Those numbers look unremarkable at first glance. They are not unremarkable at all under closer inspection. A retailer this large, running this thin, is choosing to do so because the fee covers the gap. This is where it gets remarkable in the analysis. The thinness is the entire strategy, not a weakness in operational execution. Every dollar of purchasing leverage compounds the savings to the member. Every dollar saved through SKU concentration compounds the leverage with the supplier. Every dollar Kirkland Signature captures from national brands feeds the same closed loop. The savings widen the value gap between Costco and its rivals. The wider gap renews the member at higher rates. The renewed member funds the next round of buying at greater scale. Now the analysis has to confront the competition directly. Costco sits in a field with Walmart and Sam's Club, Amazon and Amazon Fresh, BJ's Wholesale Club, Target, and Kroger. Two of those competitors press directly on the warehouse club model. Amazon's Prime membership and fulfillment network offer convenience-driven bulk purchasing that could erode Costco's warehouse trip necessity among younger demographics. The convenience pull on younger demographics is real and persistent. Walmart's Sam's Club is accelerating new warehouse openings and digital integration, directly competing for the warehouse club membership wallet share. That's the same playbook, run by a competitor with deeper logistics. These are genuine counterforces against the model. The moat has to withstand both at once over the next decade. So step back and ask the simple question. Where exactly does the profit actually come from? Not the merchandise itself. The merchandise runs at near zero margin by deliberate design, is approximately the case. The fee funds the savings to the member. The savings retain the member through renewal. The retained member renews the fee for another cycle. That's the flywheel, the self-reinforcing loop that gets stronger as it spins. That refusal is the moat, and there's the margin. Periodic membership fee increases risk churn among price-sensitive households if competitor value propositions narrow the perceived savings gap. The fee can only rise as fast as the savings gap allows. So what does this mean for you as a viewer trying to read the business clearly? When you look at Costco, don't read the income statement like a normal retailer's. The merchandise line is a delivery mechanism for value. The membership line is the actual profit pool of the enterprise. The renewal rate is the leading indicator of whether the model is intact. Watch that single number more closely than you watch quarterly comp sales. Lean SKU model creates single supplier dependencies per category, exposing Costco to availability gaps during global supply disruptions. That risk is the structural cost of running lean. It's the trade the model has accepted. The lesson here is structural, not motivational. The lesson from Costco isn't simply that low prices win. It's that a business can be designed so its profit pool sits one layer away from the thing it sells. That separation is what makes the advantage durable across decades. Read the next retailer through that lens and see where the profit pool actually sits.